Hello, Ed Yardeni here. It's June 21, and I hope you all had a great weekend. It was a long weekend. I hope you had a great Father's Day for those of you who are fathers or those of you who are here because of fathers. I guess we're all here because of fathers. But again, I hope you had a good one. I am wearing my Father's Day present. My kids got me this shirt, and it's got the Yardeni Research logo on it. Thinking outside the box, how do you connect 9 dots together with 4 consecutive lines? Well, you got to think outside the box to do that. So that's our logo. It's a fairly well-known logo. We didn't invent it. It's been around for a while, but I trademarked it, believe it or not. Nobody else seems to have figured out that it might be a good trademark. So now I'm thinking of the Yardeni fashion line. We'll see how that goes. I asked my kids if any of them wanted to be CEOs of the division, and so far I haven't had any takers. They don't think it's that great an idea. So they shot me down on Father's Day, even though we had a nice lunch in the backyard, nice barbecue lunch. Hope you all had a good Juneteenth as well on Monday. So we've got a short week here, but that doesn't mean that it's not going to be a volatile week. And hopefully it's starting out volatile to the upside, which is good news for a change. By the way, on Thursday, the market closed at 3,666.77. Why does that mean anything? Well, it means something to me. Back in March 6th of 2009, the market hit an intraday low of 666. I was at a meeting in Princeton, New Jersey, with one of our accounts, and as we walked out, one of the traders said that the market had just bounced off of 666, which is the devil number, I guess. And so we seemed to have gone to Hades and decided we didn't want to stay there very long, and so the market made an intraday low at 666. So I thought it was kind of amusing that the Da Vinci Code is back here, where on Thursday we were down to 3,666. So we were 3,000 points above the intraday low at the beginning of the bull market. Well, the bull market basically ended last week when the market dropped 20%. But it really depends on how you define a bull market. We could always kind of redefine it. I've seen some people define a bull market as down 20% or more for 6 to 12 months. Well, with this rally that we're having today, if it were to continue, then maybe we'd be able to kind of revise history and conclude that it wasn't much of a bear market, or it wasn't a bear market at all. I still don't categorize the sell-off that we had with the lockdowns in 2020 as an outright bear market. It didn't really last long enough. It was severe. It was about 33% decline, but it didn't last very long. And so I still kind of viewed it and labeled it as a panic attack. But the panic attack we've had this year has been different from the 72 that I counted prior to this year. And this one is different in the sense that the cause of the panic isn't going to go away. And previous panic attacks kind of went away partly because of the Fed put, the idea that if things really got bad, the Fed would provide another leg of stimulus to revive things. This time around, the problem is the Fed. Investors have come around this year to appreciate the adage, don't fight the Fed. And the idea is don't fight the Fed when the Fed's either easing or tightening. What we forgot about is the tightening side of it, because for so many years, you can almost argue that the Fed put has been in place since the market bottomed in the early 70s. If you look at most market bottoms, they really are associated with the Fed coming in and lowering interest rates. This time around, the Fed put is kaput, as I've said eloquently in the past. And the idea being that with inflation having come back so quickly here, reminiscent of the 1970s on fast forward, the Fed has gone from easing to tightening very rapidly. And so the idea of don't fight the Fed now is don't fight the Fed when it's fighting inflation. So we have seen quite a sell-off on that, and we were down, I guess, 24% thereabouts as of Thursday of last week, and now we're seeing some move to the upside, which is most welcome, of course. But that doesn't mean that everything is hunky-dory and we can move on and have a happy life looking forward here. I think this is going to continue to be a difficult year, a volatile year. There is more Fed tightening coming. I'm looking for 75 basis points again in July on the Fed funds rate, and 75 basis points again in September. The good news is that might be it. I don't know that the Fed really has to go much above 3.25% on the Fed funds rate, because you got to factor in that in the background, in a way, in sort of in a stealthy way that's hard to really quantify, is that the Fed is letting its balance sheet decline by about $40 billion per month through September, and then it'll be $95 billion per month after that. And nobody's really come out with a estimate of what that implies in terms of raising the Fed funds rate. What is that equivalent to, that kind of quantitative tightening? And my guess is it's probably at least 100 basis points. That being the case, then quantitative tightening actually reduces the level at which, or the terminal point for how far the Fed has to raise the Fed funds rate. Let's now turn to the charts. I kind of got it all screwed up last time. Hopefully I got it right this time. I spent a little bit of extra time setting it up. So you should be looking at this pretty well. And here's the chart collection for today. And today we spent a lot of time updating you on the latest data we have from the S&P, for the S&P 500 for revenues, earnings, and the profit margin on a quarterly basis for the first quarter. The data just came out last week. And then we compare that to our trusty weekly forward measures, variables as proxies for those. I think they're trusty. They're not that trusty in recessions. So if a recession still is right ahead here, they're not going to be all that trusty. They're going to be misleading. But let's look at what we've got here. We got revenues. They downticked a bit in the first quarter, which was actually a bit of a surprise since the forward revenues data continues to soar to new all-time record highs. And as you can see, it's got a pretty good track record of anticipating at least the intermediate kind of trend in the actual revenues. So I wouldn't make too much of this. And this is still telling me that the revenues outlook still looks pretty good. And this is the analyst consensus expectations, time-weighted average this year and next year. And why are revenues doing so well when there's so much anxiety about a recession? Well, while we haven't clearly fallen into recession, the risks are there, but inflation remains high, and inflation is kind of dollar for dollar being reflected in revenues, and that's what analysts are reflecting. So I think we're still looking at a revenues situation in the second quarter where that quarter might actually show an increase and maybe a new record high for revenues, at least based on what I'm seeing here with the forward number. Of course, if I'm going to have to draw a blue shade here for a recession right now, right here, and for the next few months, that would imply that we're going to see further weakness in revenues, actual revenues, and that analysts are going to have to scramble, as they've often done in the past, to lower their numbers. Earnings, same kind of story. This time, the earnings story looks still pretty good. By the way, in the first quarter earnings season, right before we got into the season, the analysts were expecting a 5% increase. It turned out to be an 11% increase, so it was better than expected. But investors aren't really paying much attention to all of that. They don't believe the analysts. As I've written of late, the analysts seem to be from Venus, and the investors seem to be from Mars, and the Martians have taken over the market here since the beginning of the year, and they simply just don't buy these heady expectations from the for the analysts. Keep in mind, the analysts are talking to companies; they are following companies. If there was a recession right here and now, I think the companies would be communicating that to all of us, and the analysts will get the message. But maybe they haven't gotten the memo yet, while the analysts got the investors got an advanced copy of the memo. Again, another controversial area here is the operating profit margin. The red line, the weekly data shows that it remains stalled, but stalled at a record high. So that's pretty good, all in all, considering all these labor cost and material cost increases that have been occurring. Yet the profit margin, even in the first quarter, held up pretty well, consistent with the weekly data. So that's all fairly impressive. Figure 2 here, we're looking at the growth rate in revenues is up 13.6% year over year. By the way, in the morning briefing for tomorrow morning, I'm working on looking at business revenues, which is a monthly series that comes out at the same time as retail sales. And it's a really good indicator of the underlying trend in revenues, and it's totally consistent with revenues growing around 13.6%, the data being through April. But again, things can change, and we are seeing that some of those indicators, like this one, the revenues as well as the earnings, are correlated with the purchasing managers' indexes. And the purchasing managers' indexes, certainly the regional stuff, is starting to look weak, kind of zero comparisons is what it's suggesting, or 50 readings for the MPMI is what the regional stuff is indicating. And so we are in the part of the revenue cycle and in the earnings cycle where growth is slowing down. And in the past, it's slowed down, and sometimes it's gone negative, which has been in recessions. And sometimes it's slowed down without going into recession, 2014, 15, 16 being an example of that. Where am I? Still 45% risk of a recession. I think we could have a stagflationary environment with a very slow growth of about 2% underlying. And inflation, I think, is going to peak in the next few months and moderate somewhat, not a lot, but moderate enough to give us some relief on concerns that it's totally out of control. You can look at figure 4 and 5 on your own. It's sector analysis of revenues and earnings, just to see just how widespread or narrow are the moves in these revenues to the downside and earnings to the upside. And basically, the picture still looks pretty good, including if you look at the operating profit margin. Some weakness in consumer discretionary. Obviously, the retailers have had a pileup in their inventories, and they're getting some squeezed on their profit margins. The other part of the morning briefing that focuses on earnings is just kind of an update on the mega cap 8 and how what kind of impact they're having on the overall market. And as you can see from this chart, this is the market cap of the S&P 500 with and without the mega cap 8. So we've had a significant drop off in the mega cap 8. I've had some people tell me, why do I have Netflix in the mega cap 8 anymore? Well, it's nostalgia. I mean, you know, I'm not going to, we're trying to look at the extent to which the mega cap 8, which had topped out here back at late last year, the extent to which they've come down. And I used to call them the Magnificent 8, but they're not so magnificent anymore. But they clearly have had something like 40% of the drop in the market cap of the S&P 500 since the beginning of the year has been related to a drop in the mega cap 8. And here you can see the mega cap 8 are now still significant, 22.5% of the S&P 500 and 44%, let's say, of the growth index. So they still matter a great deal, and they can have an outsized impact on moves in the market. Today, they're doing pretty well, and so the market's doing pretty well. Here's the mega cap forward PE. By the way, if some of you want to start putting in some Qs in the Q&A. I'll get to them in a minute or two. I have one so far. Mega cap 8. We're looking at the PE here, and you can see that the PE is well, it's interesting. I mean, the PE was right around, what is it? Let's call it 28 before the pandemic. So they weren't cheap before the pandemic. Then they took a dive, but it held up above 20. And then everybody concluded the mega cap 8 were the obvious winners from people working from home, getting entertained at home, going to school at home. And so the mega cap 8 had this huge run in the forward PE. Then it subsequently, with the benefit of hindsight, has been kind of moving lower. So its heyday was right there in late 2020. And then we gave back some of that. But the big give back was really since the beginning of the year, or the end of last year. We were like, it's still at 35. And then we're now down to 22.2. So we're almost back to where we were at the bottom of the lockdown recession. So they're cheaper. They're not giving them away. I mean, there was a time here when you could buy them in multiples of 10, 15, and certainly under 20. And maybe that's where they're headed. And I think if nothing else, the market's starting to distinguish between the individual mega cap. Aren't all magnificent. Some still are magnificent, clearly, but some have had some bad news and have had reversals of fortunes and seen their capitalizations come down dramatically. Here's the forward price to sales ratio. You can look at that on your own in the morning briefing. Let's look at the forward PE ratio of the S&P 500 with and without the mega cap 8. It got, let's look at it without the mega cap 8. Mega cap 8 are kind of still controversial whether you want to pay these kind of multiples for them, but take out the mega cap 8, and there's a bunch of other stocks in the S&P 500 minus 8, and you can see that we got down to 15, which is kind of fair value by historical standards, as long as we're not in a recession. In a recession, the forward PE tends to fall below 15, and it could fall into single digits. And I guess that's what really has the market spooked here, is that even though the PEs come down quite a bit, there might be more downside. But again, I think if we have a recession, it's going to be a mild one. I don't think it's going to last very long. I don't get a sense that there's a real credit crunch out there. There's an inventory problem maybe for some of the retailers, but the good news there is they're going to have to get rid of that by cutting prices. So that could give us some moderation, at least on consumer durable goods inflation. So I'm not convinced that we got a lot lower to go here. All I can tell you that what I'm thinking right now is there ain't a lot of upside in the market right now, as long as we don't see a convincing peak in inflation, and until we get a convincing sign that the Fed is pretty much done tightening here. So I think the market's going to remain kind of challenged to the upside here. This is the price to sales ratio you can look at on your own. I do discuss some of the valuation issues that are still troublesome. So, for example, if you look at the forward PE versus the forward PS, this is the forward price to forward. This is the price to forward revenues series, and a lot of people have pointed out that while the forward PS, otherwise known as the Buffett ratio, has come down quite a bit, it's still quite high at 2.1. I think Buffett, way back when he started talking about this ratio, said that he'd much rather buy things when the ratio is 1 than when it's 2. And here we got well over 2 in this particular situation, and now we're down to 2.1. But keep in mind that one of the reasons the price to sales ratio is still fairly elevated, especially compared to the price to earnings ratio, is because profit margins have picked up so well. So if you look at this chart, you can see that the relationship of S&P 500 actual quarterly earnings using the IBES series for operating earnings per share versus revenues. So revenues is the blue line, and earnings. So we just looked at those up above, but now I'm putting them on the same chart. And by the way, 50, 600, 560. So the scales are designed in a way that show that the reason that earnings have done so well relative to revenues is because profit margins have really just exploded to the upside, and that's the big issue. The super bears, the perma bears, maybe the realistic bears for some of you. The concern is if we have a recession, and recessions, the profit margin almost always declines, and revenues decline and earnings decline. So, earnings decline because revenues drop and because the profit margin drop, and that's still ahead of us. I mean, we've seen revenues continue to march to the upside. We've seen earnings to the upside. We've seen the profit margins. All we've really seen is the PE take a dive, presumably in anticipation that all this is going to start coming apart. And if in fact this does start coming apart, then this is going to be a worse bear market than what we've had so far. And some people are talking about 40, 50% kind of declines. I'm not there, but that seems to be kind of a widespread concern. And some smart people like Leon Cooperman just recently was saying that he thought the market could drop 40%, and it's going to be a long time before we see 4,800 again. You can look at the story on the real earnings yield on your own. That's another kind of valuation model that's of concern. But the real earnings yield has some correlation. I see it. Maybe you don't, but I see some correlation between the yearly percent change in leading indicators and the real S&P 500 earnings yield. And it's somewhat encouraging that while the real earnings yield is clearly in bearish territory and has a pretty good track record of being negative during bear markets, as you can see here. Not always, but it definitely comes down in bear markets, and more often than not has been negative. I'm sorry, I should have been looking at the blue one here. So let's do that again. So it's the blue line, the real earnings yield that is tend to be negative. So it's negative here, negative, 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 but no bear market, slightly negative. So we had that 80, not negative here, but no, a bear market that didn't last very long. Bear market, stick with the blue again. So this is concerning, but on the other hand, let's keep an eye on the leading indicators to show us with the way. And we had two monthly declines in the real in the leading indicators, so it is something to be concerned about. Meanwhile, speaking of Venus and Mars, the analysts remain on Venus, and as you can see, their expectations for 2022 and 2023 revenues all-time record high, but maybe it's starting to flatten out here. Meanwhile, the time-weighted average all-time record high, as we saw before. Look at earnings. There again, you can see that the 2023 remain on an upward trend, same for 2022. So like what recession or whatever recession they see out there, they think it's going to be more than offset by companies being able to maintain profit margins and pass through prices. So these are nominal numbers, obviously. But you can see that historically, and we have the data going back to the 90s, you can see that the analysts do tend to start to be too optimistic and have to lower their numbers during economic expansions. It's during recessions that they realize just how wrong they are and have to, even in back here in 2020, they were lowering their numbers, not because they saw a recession coming, because they were too optimistic. And so as they got closer to reality, to the actual numbers, they lowered there. But then the pandemic hit, and then that's when things really started to fall apart. So I think that's certainly a possibility here, that we could have a recession and their analysts, the estimates start to go down, or it could be a very mild soft landing kind of scenario where these numbers come down, but the forward earnings continue to go up. So I will be watching these things carefully on a weekly basis. And meanwhile, the profit margin, both actual and estimated, is holding up pretty well. So I made it through the charts without messing it up the way I did last time. Let me do some Q&A here. Scott, the media loves to talk about Powell and his potential to be like Paul Volcker. What they do not talk about is that Paul Volcker had debt as a percentage of GDP around 25 to 30%. Today, we are over 120% of GDP. How can Powell possibly be able to do what Volcker did? Your thoughts? Well, Powell could do what Volcker did. He could, raise interest rates dramatically, or turn into a monitor. Since the Fed no longer has an opinion on interest rates, they'll go wherever the market wants to take them, and that could certainly cause a recession. I don't know that the debt to GDP ratio would be an impediment for that kind of response, if in fact we get a much more dire inflation scenario. But I think what you're saying is that it's hard to imagine how interest rates could stay high for very long without leading to a compounding problem for debt generally, and specifically for federal debt. And that is a concern here as we look at the rest of the decade. Michael, any thoughts on BOJ issues? Yeah, we're going to be writing about it for tomorrow. The BOJ is in Never Land. The head of the BOJ a while ago basically compared monetary policy to Never Land, convincing people that they can fly, or convincing people that the central bank can fly, and the BOJ just hasn't gotten over that idea that they can do whatever they want to do. And what the problem is that the BOJ could maintain ultra easy monetary policy when the other central banks were maintaining ultra easy monetary policy. Now the Fed and the ECB are in tightening mode, and the BOJ wants to stay in Neverland in ultra easy mode, and that's weighing on the yen because they're doing their best to keep their bond yield from going up. But I don't know if that'll be the source of some sort of global crisis. Japan does matter a lot in the global financial world, and whether that something happens that reverses some flows that suddenly causes a problem is something we're thinking about, but not something we're incorporating into kind of a base case scenario. So right now it looks more like an outlier. And by the way, the Chinese central bank, same kind of story. Their economy is weak. Their COVID-0 policy is kind of insane. But that's all leading to weakness in their economy. They were thinking about, or they were looking into lowering their prime rate, but they decided not to do it because unlike the Bank of Japan, which thinks they can just keep going solo their merry way, the Chinese central bank realizes that they can't be easing aggressively here when the U.S. and Europe are tightening. Kyle, do you buy the idea that a slowing rate of inflation could be a careful, what you wish for type of situation, whereby revenue growth contracts and pulls earnings margins down at an even quicker rate due to the reversing of operational leverage, maybe a 2024 problem? That's a good question. I've been looking at inflation as going straight into revenues. Revenues, nominal GDP, all reflect inflation on a one-to-one basis. But earnings don't have to reflect inflation. It all depends on the profit margin. If you got revenues being boosted mostly by inflation, and somehow or other companies are able to pass through their costs into prices so that their profit margins remain high, notwithstanding rising costs, then earnings will rise, also reflect inflation, which it seems to be exactly the situation that we're in now, or exactly the situation that analysts think we're in now, and that's what they're reflecting. What your concern is that if the underlying premise of all that changes, if we have a recession, obviously things will change a lot. What you're raising an interesting issue is, well, what if it just, if the real big change is inflation really moderates, even if it moderates slowly? I'll think about that one, but I think at this point the bigger issue is the impact of real GDP growth, real economic growth on revenues and on earnings, and particularly on the profit margin. Okay, Mike, why do you think sentiment indicators For example, the bull-bear ratios seem to be less predictive at the moment. Do they become less useful when structural changes are occurring in markets? That is, are they sending a message themselves? Yeah, I've been thinking about that. I've been showing you the sentiment indicators for a while here. And I think, contrary analysis just doesn't seem to be working all that well. Maybe just got to give it some time. We've seen the bull-bear ratio below 1 for a long time during previous bear markets. So it's definitely a good long-term indicator of sentiment being so bearish that there are, the market's probably so cheap that there are some really good long-term buying opportunities. But again, you may sweat it out using a 1.0 or less bull-bear ratio as an indicator to just be fully loaded up. In this kind of an environment, sentiment indicators are telling me that there are lots of good values for long-term investors, but there's no rush to just jump in. We'll see how today's rally lingers and whether it continues. But I think at the end of the day, it's hard to see contrary analysis work when the basic issue is the Fed. And the basic issue with the Fed is don't fight the Fed when the Fed's fighting inflation. So you have to have a real contrarian view on inflation, which then leads to a contrarian view on the Fed. It's hard to imagine that inflation is just going to suddenly come down dramatically. I think, as I've said before, I think it's going to be moderating in the second half of the year. But I think it's already started to moderate, but not in a way that's definitive and is one that enough investors want to discount. I got two more. What is your, Tomas, what is your view on energy supply going forward? Will it significantly increase inflation pressure in the coming years? Is there a way to overcome it? This is probably the biggest issue here, looking at the decade ahead. I've been talking about the possibility of a roaring 2020s decade. It doesn't feel like it right now. It feels more like the 1970s. In the 1970s, obviously, had a lot of inflation, and a lot of that was based on geopolitical crises, and a lot of that was led to higher commodity prices, particularly energy, and that was the major source of inflation. And certainly seems like deja vu all over again, though it seems like the 70s on kind of fast forward or speed and steroids, just happening very, very rapidly. So maybe it'll kind of self-extinguish sooner rather than later, which is kind of my bet. But the bad side, the dark side, or the alternative to the roaring 2020s is that we do have a significant problem with energy supply. And a lot of that's been exacerbated by climate activism. But it looks like the climate activists are in retreat here, where you have European countries now opening up coal-fired plants in order to keep their people warm during the coming winter. And Biden going to Saudi Arabia to plead with them to produce more oil. I don't know why he doesn't just stay here and keep pleading and convincing the oil executives that he kind of likes U.S. oil and wants them to produce more of it. We are, by the way, seeing that the weekly field production is starting to, it looks like it's breaking out to the upside, if I may technically analyze the production of oil. It looks like it's about to hit 12 million barrels per day. So the high oil prices starting to have the impact that you would hope it would have in stimulating production. So there's plenty of oil. I think it's just a matter of whether there's the political will to produce it. We're seeing American companies making commitments to produce and provide liquid natural gas to Europe. So I think that the climate activists were always very naive, never really did the cost-benefit analysis, and now they're paying the price because the political blowback to their attempts to get things moving real quick is such that consumers around the world and politicians around the world are saying it's just not going to work to make this transition this quickly. and it's not going to work. People aren't going to tolerate these kind of high prices, and people want their electricity. People want their gasoline and gas, and the politics are starting to change on that. So without getting into whether you're for or against climate change, the bottom line is it looks like the fossil fuel industry is going to get some support for a change, and that might lead to more supply, at least in the short run. Anonymous, if US dollar continues this significant rally, it will hurt earnings, which in turn will lower market expectations further. Do you agree? Well, yeah, I think we've seen that. We saw that in Microsoft, for example, that announced that it had somewhat disappointing earnings because of a strong dollar. I mean, I'm fundamentally in favor of a strong dollar. I think it's a good reflection on the U.S. economy, but you don't want it to be too strong because it would have a negative impact on earnings. So it is something to factor in, and maybe some of the mega cap 8 that do have the foreign exposure, currency exposure, that's contributed to their weakness of late. Well, that's it. Look, have a great week. Hope this rally continues for a while. Wouldn't mind if it just kept on going, but one has to be realistic. And realistically speaking, I think we still have a few challenges ahead of us. I know the market is forward thinking and can maybe has discounted a lot of the trouble that now is the market is focusing on some happy stuff, like maybe a major political upset in the midterm elections, for example, and maybe a peak in commodity prices because of slower economic growth. But never a dull moment. Please tune in, read the morning briefings. I hope you like the quick takes. Let me know what you think of them. Let me know if there's too many of them or whether they're quick enough. Let me know if the morning briefing is too long. But all in all, again, we appreciate your support, and I'll let you know if we're going to go into the fashion business at all. Thanks.